Hello students, welcome to BYJU'S IAS. Welcome to a session on economy this week, wherein we'll be taking up some of the very important articles that have appeared in various business-related newspapers, and we'll be analyzing these particular articles. For this particular video, I've chosen the time period from 16th to 22nd November 2020, and the articles that I've chosen are from Business Line, Hindu, Business Standard, Indian Express, Live Mint, and Financial Express. Let's begin the discussion. The first very important article is with respect to RCEP. RCEP stands for Regional Comprehensive Economic Partnership. Now, some of the very important points with respect to RCEP are: 1. This is one of the free trade agreements that has been signed very recently by 15 countries. Initially, when this was proposed back in the year 2012, it was actually initiated by ASEAN, which is a grouping of 10 countries. This particular proposal consisted of 16 countries. Out of this, India was one of them. India very recently, that is at the end of last year, decided not to join RCEP and it quit the negotiations which were being conducted earlier. As a result of this, 15 countries have gone forward and very recently have signed this particular agreement, and this has basically been in the newspaper. Now, some of the very important points with respect to the concept of RCEP is, understand this, in order to promote the trade, generally there is a concept of economic integration model which is discussed. In this particular economic integration model, at various stages, there is an increased economic integration, or the complexity of the trade keeps on increasing. Initially, the concept of economic integration model starts with free trade agreement. After free trade agreement, there is a concept of customs union. After customs union, there is a common market. And after common market, there is a economic union. After this, there is again political union, but that is not important in the context of economics. Now, generally what happens in a free trade agreement, in case of a free trade agreement, two member countries will sign an agreement with each other. Under this, they'll basically agree to impose a certain specialized tariff structure. That is basically A, which will export goods to B, or let's say services to B. B country will either impose a very low amount tariff or no tariffs on these kind of imports. And in return, when B will export goods, services or investments to country A, same kind of a preferential treatment or preference is given in terms of lower tariff or no tariff. The objective is generally to promote the trade amongst these particular countries. Now, the free trade agreements can be done between two countries or multilateral countries or group of countries. And the concept of RCEP is a type of a free trade agreement itself. Apart from this, the concept of ASEAN or the grouping of ASEAN partially is a concept of free trade agreement itself. In addition to this, if you speak from the context of India, India has signed multiple free trade agreements with multiple countries. For example, India has a trade agreement with Japan. India has a trade agreement with South Korea. India has a trade agreement with ASEAN itself. Now, the second point, customs union. Under the concept of a customs union, these particular group of countries which have signed a free trade agreement will have common external custom tariffs. That is basically whenever the goods will start coming into these particular countries, in what way the tariffs will be imposed by all these particular member countries will be decided under the concept of a customs union. Then comes the concept of a common market, under which basically the services movement will be much freer. And finally, there's a concept of an economic union, wherein you can find a common monetary policy which could be formed by this particular group of countries. Free movement of a people can be found under this particular concept. So this is basically how the economic integration takes place in the global market. And whenever there's an economic integration which is happening on these particular lines, generally you will see that the trade will keep on increasing. The movement of a financials, movement of a capital, movement of a human resources, etc. will also keep on flowing from one country to another country. And as a result of all of this, investments, capital formation, the contribution to global trade, global GDP growth rate, etc. will also keep on increasing. This is the basic idea of an economic integration model. Now, in case of India, though there was an option for India to join this particular grouping, that is RCEP, India opted not to join this particular RCEP. What are the reasons for this? Just give me a couple of minutes. I'll explain that particular idea to you. But before that, Once the RCEP comes into application or implementation, this will be the biggest trading bloc in the world. RCEP will account for around 30% of the global trade. It will also account for around 30% of the global population. The next very important point with respect to RCEP is it will cover goods, it will cover services, and it will also cover investment. Now coming to the most important point, why did Government of India decide not to join RCEP? Here are some of the very important facts related to this. First and foremost, India wanted a very strict rules of origin guidelines. Now what is this particular concept of a rules of origin? In case of the China, that is the second factor here, I'll club both of them. In case of China, India has a huge amount of a trade deficit with this particular country. Now what is this idea of a trade deficit? That is basically the difference between imports as well as exports. If imports value is higher than exports, generally we will refer to this as a trade deficit. In case of China, today the trade deficit that India has is more than $50 billion. And in the last 15 years, this particular deficit has kept on bulging or ballooning in favor of China. Now in case of China, what Government of India has done is, in order to control the imports which are coming from this particular country, Government of India has imposed multiple types of tariffs. But it has been found that in order to escape from these particular tariffs, Chinese exporters are basically routing their exports from a third country. Now to counter this, Government of India wanted a very strict rules of origin. Basically, in case of a rules of origin, what happens is the exporter has to prove certain amount of value addition that has happened in a respective country. For example, again going beyond this particular concept of RCEP, Government of India has introduced Carotar guidelines. Under this particular Carotar guidelines, which has come into force very recently, the exporter will have to prove that at least 35% of the value addition has happened in his home country. That is, let's say we are importing something from Malaysia. The exporter in Malaysia has to prove that at least 35% of the value addition on this particular product has taken place in Malaysia itself. If he is unable to prove that, then a different level of a tariff is applicable on these particular exports. So basically, Government of India, when the negotiations were being held under the concept of RCEP, wanted a very strict rules of origin guidelines, and this was not accepted. This was one of the reasons. And here's the current affairs. Government of India, rather than being dependent on RCEP guidelines, has already implemented Carotar guidelines, which again discusses the basic idea of a rules of origin application. Second, India was very much worried about the trade deficit that already has with China. Despite implementing so many tariffs, despite taking measures to reduce the imports coming from China, the trade deficit with China has been ballooning. And the dependence on imports from China also has been increasing. In fact, India joins RCEP, then it has to withdraw certain tariffs, that is basically reduce the customs or the taxes which it is imposing on the imports which are coming from multiple countries, especially from RCEP member countries. And if that actually happens, then Chinese exporters would simply flood the domestic market or the Indian market. And if these particular cheaper imports will flood the domestic market, then the domestic manufacturing would be affected in a very great way. That was the biggest concern which has been raised by Government of India for not joining the RCEP. Third very important reason for Government of India to not join RCEP is Government of India usually gives the concept of a most favored nation to its strategic allies. Now you'll ask me a question, sir, what is a most favored nation? The basic idea of a most favored nations is one of the pillars under WTO, World Trade Organization. Most favored nation basically means a member country should not be biased against imports which are coming from another trading partner, that is basically a member country of WTO. That is, in simple terms, imagine India is conducting trade with A, B and C. The most favored nation basically means that the imports which are coming from country C into India shall not be treated unfairly by Government of India. The same treatment shall be provided by India as if these particular imports are coming from country A as well as country B. But having said so, even under the concept of WTO, there are certain exceptions to concept of a MFN. For example, free trade agreements is an exception. Generalized system of preferences is again an exception. So basically, Government of India provides the most favored nation status to its strategic allies. But under RCEP, it was being asked to provide most favored nation to the investments which are coming from other RCEP members. Government of India did not specifically want, or it was not interested in providing this particular MFN status to investments which are coming specifically from China. This was another very important reason. Next, fourth very important reason is with respect to tariffs. Now understand this, from 1990s till 2013-2014, the tariffs, that is average tariffs in case of India, have been reducing from 125% to around 13 to 14%. And post that, the tariffs have increased to around 17 to 18%. Now here comes a problem. Under the concept of RCEP, the government of India was asked to reduce the tariffs on the basis of a 2014 number. But government of India wanted this to be 2019. The basic idea is the tariffs by government of India on the imports have been increasing post 2014. And if 2019 is the base year, then the tariffs will be reduced from a higher level to lower level. But if 2014 is taken as a base year, then the tariffs would be reduced from much lower level to another much lower level. This was another issue which was raised by government of India, which was again being negotiated under RCEP. In addition to this, another very important reason was India's experience with other free trade agreements. As earlier mentioned, India has a free trade agreement with South Korea, with ASEAN, etc. And India's performance with respect to these particular FTAs has not been very satisfactory. That is, as per one Niti Aayog report, it has been shown that the trade deficit with the signing of these particular free trade agreements has increased in the context of India. That is, basically, India's trade deficit with RCEP members after India has signed these particular free trade agreements has actually expanded, which in other simple words can be said like this. After signing the free trade agreements, the other trading partners have got more benefit out of this particular agreement compared to India. That is the precise reason why these particular free trade agreements are being reviewed by government of India now. So these are some of the reasons which have been cited by government of India for not joining RCEP. Now, if government of India doesn't join RCEP, what will happen? I'm using the term it doesn't join for a simple reason. Understand this very carefully. Though this particular RCEP deal has been signed by 15 member countries of RCEP, excluding India, the window for joining RCEP has been kept open. Under this particular RCEP, if any other country wants to become a member of RCEP, it has to give application in writing, and then there's a waiting period of 18 months. This particular waiting period is mandatory. But RCEP very recently has stated that this particular waiting period will be waived off for India. It has to give a written application to RCEP showing its interest to join RCEP. Then what is the situation that will be taken into consideration in order to negotiate with India? So this is the window that they are actually referring to, that is open for India to join RCEP even today. Now, if India decides not to join RCEP even after this, what will be the problem? What India will be missing out? First and foremost, the former CEA, Mr. Arvind Subramanian, has basically stated that in the global market, because of the pandemic or because of rising protectionist trends amongst some of the developed countries, more and more countries are signing these kind of multilateral agreements to protect themselves. On the other hand, India is moving away, or India is moving in exactly opposite direction. That is the first very important issue. Second very important issue is, if RCEP comes into force without India being a partner in the RCEP or member in the RCEP, then these particular 15 member countries will improve the trade amongst themselves, or there is enhanced trade amongst these particular 15 member countries. India will be left out of the block. Next very important problem with respect to this is the export related investments or export driven investments. India will be finding it very hard to attract this particular export driven investments if India doesn't join the RCEP. Next very important problem is India is not a very big country in terms of a participation in global supply chains or global value chain systems. If India doesn't become a member of RCEP, then India might lose out on joining a major player or becoming a major player in the global value chains in the global market. So these are some of the issues which have been raised by various experts, which would harm the Indian prospects if it decides not to join RCEP any further. So these are certain very important points with respect to this particular RCEP. Now, based on this, I have given a question here. The term carotar often appearing in the newspaper refers to option C, rules regarding the country of origin or rules of origin. Now, in addition to this, if you want, you can take down a mains descriptive question that is basically critically evaluate the RCEP. Again, this is a straightforward question. Whatever we have discussed so far is basically the idea of a critical evaluation itself. The question could be given in a twisted manner also, but if you can understand what is the concept of RCEP, why India should have become a member of RCEP, what will happen if India doesn't become a member of RCEP, and what are the concerns which have been showcased or which have been told by Government of India for not joining RCEP, if you know that, more than sufficient. And the last final point with respect to concept of RCEP will be way forward. If Government of India does not join RCEP, then it has to enter into more and more agreements. What kind of agreements? Free trade agreements. For example, right now the negotiations are going on with the European Union. That is another very important market for us. India can sign a free trade agreement with that. Another set of negotiations is happening with respect to United States of America. Again, that is a very important trading partner for us, with which specifically we have a trade surplus. So India should enter into more and more free trade agreements so that Indian exporters will get access to more markets, right, with signing of these particular agreements. Second one, manufacturing in case of India should be improved. Quality manufacturing should take place, which will result in India becoming one of the major dominant players in global value chains. So these are the two very important way forwards that India should adopt if it does not join the RCEP in the coming days. So the next article is with respect to PSEs and dividend. First and foremost, what is this particular concept of a dividend? Any company which has issued shares will pay returns to the owners or the shareholders. I'll repeat the statement here. Imagine company C has issued shares. These particular shares have been purchased by the investors. Now these are referred to as what? Shareholders. Now these particular shareholders are paid certain returns by this particular company from the profits that it has generated. This particular return given to the shareholders is referred to as dividend. Now, Government of India owns majority of the stake in CPSEs, Central Public Sector Enterprises. And since Government of India owns majority of the stake in CPSEs, it expects a huge amount of a dividend from these particular CPSEs. And next very important point, these particular dividends which are garnered by Government of India form a very important source of the non-tax revenue receipts for the Government of India. Now, what is this particular non-tax revenue receipts for the Government of India? Understand this. Whenever Government of India will present the budget is divided into two parts. One is called as a revenue side and the second one is called as a capital side. Now, I'll be focused on the revenue side. Within the revenue side, there are two sides. One is called as a revenue receipts and the other one is revenue expenditure. Focus on the first one again here. Revenue receipts again are two types here. One is called as a tax revenue and the other one is non-tax revenue receipts. Focus on the latter one, non-tax revenue receipts. Under non-tax revenue receipts, Government of India collects receipts in the form of dividends from CPSEs, surplus transfer from RBI. Whenever there is a sale of a spectrum, government will also collect a huge amount of charges or revenue from the spectrum sales. So these are the three very important sources of revenue or non-tax revenue receipts for Government of India. Now in recent times, Government of India's tax revenue receipts have taken a hit. Right? For example, in this particular article itself, it says that the tax revenues for the month or for the duration April to September have come down by 21.6% compared to the same tenure in the early year, and the total tax revenue collected for this particular duration stands at 7.2 trillion rupees. And another very important point that you should remember with respect to this particular tax revenue, majority of the tax revenues or the sources of tax have taken a hit. That is, the tax collections have come down. One very important source of a tax revenue which has increased in the present or the current financial year is the excise duty that Government of India collects. And specifically, this particular excise duty collection has been higher because of increased excise duty by Government of India on petrol as well as diesel. So coming back to the original discussion here, the total revenues of Government of India have taken a hit. On the other hand, the total expenditure of Government of India, especially the revenue expenditure, have kept on increasing. This has forced or this has expanded the fiscal deficit of our Government of India. Now at this particular situation, Government of India has basically asked these particular CPSEs, which is majorly owned by the Government of India itself, to pay higher dividend rather than paying normal dividend, Government of India has asked these particular CPSEs to dip into their reserves. That is basically the profits which are carried on from one year to next year. The profits which is undistributed are kept in the form of reserves. These particular reserves, Government of India wants the CPSEs to dip their hands, basically take out these particular reserves, hand it over to Government of India. Next point, the total dividend that is paid by these particular CPSEs to Government of India has kept on declining, or there has been a declining trend with respect to the payment of a dividend from CPSEs to Government of India. As shown in this particular graphical representation, you can see that basically the dividends which were transferred from the CPSEs to Government of India in the year 2009-2010, that is the year when it peaked, was 0.33% of GDP, and this has kept on steadily declining, and from 2019-2020 data it shows that it stood at 0.24% of GDP. So what it basically showcases is that the dividends which are paid by the CPSEs to Government of India have kept on declining, and have declined especially in the last couple of years. Now, in addition to this, this decline seems very rational if you look at the profitability of these particular public sector enterprises. As per the graph given here, the profitability of these particular CPSEs stood at 1.45% of GDP in the year 2009-2010 and has kept on declining, and for 2018 and 19 this particular number stood at 0.7% of GDP. As the profitability of these particular CPSEs have been declining, the dividends paid by them to Government of India also has taken a hit. The next point is with respect to these particular CPSEs. For the financial year 19, it has been found that of 1.43 trillion of profits which are generated by these particular CPSEs, the top 10 CPSEs accounted for more than 75% of these particular profits. That's the first point. Second very important point, of 249 operating public sector enterprises for the financial year 19, it has been found that 70 of these particular CPSEs are incurring huge amount of losses, which basically showcases the reason for this particular decline in the dividends which are given by these particular CPSEs to Government of India. In addition to this, another very important reason as to why Government of India is forcing these particular CPSEs to pay higher dividends is because of the disinvestment target. For the current financial year, Government of India has set up a disinvestment target of 2.1 trillion rupees. Out of this, it has been able to collect only around 5,700 odd crore rupees, which comes at around 2.7% of the targeted budgeted number. So this has put a lot of financial pressure on the Government of India. As a result of this, it has basically sent a notice, a guideline to all of these particular CPSEs to transfer higher dividends to the Government of India. So this is the gist of the article given here. Based on this, I have given a question here. Which of the following form part of non-tax revenue receipts for the government? Telecom spectrum receipts, yes. Dividends from CPSEs, yes. Dividends from RBI or surplus transfer from RBI. All the three are correct. Option D is the correct option here. The next article is in relation to inflation. Now, as per the recent data which has been published in the newspaper, the wholesale price index has hit a 8-month high of 1.48% for the month of October, and CPI has hit a 77-month high of 7.61% for the same month of October. In addition to this, core WPI has also reached a very high level, that is 18-month high of 1.7%. Now, this is just a data. Should you mug up this particular data? Not required. What you need to understand is what is the implication of this data. That is very, very important for you. First and foremost, this particular CPI, that is Consumer Price Index, which is also retail inflation, has been hovering more than 6%, which is a mandated number. That is basically under inflation targeting. Government of India has asked RBI to maintain the inflation rate at 4% with a relaxation of 200 basis points on the either side of the target. So this particular retail inflation has been hovering more than 6% for the last many months. In fact, in this particular year, that is a calendar year, except for the month of March, in all the months, the retail inflation rate has been more than 6% itself. Now, what is the importance of this? Whenever the retail inflation is higher than 6%, it will force RBI not to cut the lending rate. I can understand the statement here. RBI, if it wants to promote growth, one of the ways of promotion of growth is what? Cut the interest rates, for example, cut repo rate, which will basically translate into lower lending rates by the banking sector, which will increase the lending activity in the market, which will lead to economic recovery. But because the inflation target mandate is 6% and retail inflation has been hovering more than 6% for many months now, RBI is forced or RBI's decision to cut the lending rates might be postponed. That is first very important implication. Second very important implication is the core WPI. The core WPI has picked up and has reached 1.7%. This is a 18-month high of the inflation rate or core WPI. First and foremost, what do you mean by core? Generally understand this. There are two terms while measuring the inflation. One is called as the headline inflation and the second one is core inflation. In case of headline inflation, we will consider all the commodities and calculate inflation. In case of a core inflation, there are certain commodities whose prices are very volatile. There are certain commodities whose prices keep on fluctuating to a very great extent in the market. Hence, we will exclude them and then calculate the inflation. That is called as a core inflation. So, in case of a WPI, core WPI has hit 18-month high of 1.7%, which basically indicates there is increased demand in the market. Now, third very important point, one of the ways or one of the most important ways through which recovery would happen in case of Indian market is through higher demand or increased demand. When you see WPI data, yes, there is an indication that there is increased demand in the domestic market. But this is slightly undercut by the fact that the retail inflation rate, which basically affects all of us, that is basically the consumers are affected by this inflation rate, has been hovering more than 6% for the last many months. Generally what happens is, when the retail inflation keeps on increasing like this, it will basically affect the real rate of returns of the people who are saving in the domestic market. And second, it also affects the consumption of the households. That is, in simple terms, when retail inflation will start increasing like this, it will basically reduce the purchasing power of the households, which will reduce the consumption or the purchasing that is done by the households. So this is going to again affect the recovery that could happen in the domestic market. So these are the three very important implications with respect to this high retail inflation as well as a WPI number or the data that has been given in the newspaper. The next article is with respect to LVB Bank, Laxmi Vilas Bank. Now very recently, RBI has announced that it will be taking this particular LVB Bank and merging this particular bank under DBS, which is a wholly owned subsidiary of a Singapore bank. Now, what was the reason why RBI has done this? RBI has cited higher NPS in this particular bank, mounting losses in this bank. As per RBI report, in the last 3 years, this particular bank has kept on increasing value of the losses. And third, the deposits in this particular bank have been reducing. As per RBI report, the deposits have shrunk down to 6,900 crore rupees. So, citing these three reasons, RBI has announced that it will be merging this particular LVB bank with DBS bank. Now, before this particular decision was taken by RBI, it basically put this particular LVB bank under the concept of prompt corrective action, PCA. Under prompt corrective action, basically, RBI takes some of these particular banks whose NPS, whose liquidity, whose capital adequacy ratio are deteriorating. Basically, the quality or the performance of this particular bank keeps on deteriorating. It will keep it under this particular framework of a prompt corrective action, and it will also impose additionally certain restrictions. As the condition of the bank keeps worsening, the restrictions imposed by RBI will also keep on increasing. Basically, this particular framework was introduced by RBI in order to restore the health of the bank. Now, despite keeping this particular bank under PCA from the last year itself, the health of the bank has further deteriorated. The promoters of the bank or the owners of the bank have not been able to come out with a resolution plan. So, RBI very recently announced that in that particular case, we are announcing the merger of LVB Bank with the DBS Bank. Now, let's go beyond this particular factual information. First and foremost, understand this. With the announcement of RBI, the equity capital investors money has been written down. What do you mean by this? Imagine here is a LVB Bank. If you have invested in the shares of this particular LVB Bank, it is basically equity capital investment. Then the value of this particular investment has been reduced to 0 rupees. In addition to this, if you remember earlier, there was one more bank which fell into problems, that was Yes Bank. And in case of Yes Bank, basically RBI had reduced the investments of the investors in the 81 bonds to 0 rupees, or basically they had written down that to 0 rupees. But in case of LVB Bank, it has been reduced to 0 rupees in case of equity capital investors. These equity capital investors have already opposed this, and they are saying we are waiting for the detailed plan to be announced by RBI. Then we might go to court against this particular RBI action. That's the first very important implication. Second very important implication is this. This time, RBI has been much more proactive. In what way? It has not waited for further deterioration of health of the bank. Before the further deterioration takes place, RBI has taken an initiative and has announced merger of LVB with DBS. Third very important point, though the argument of equity capital investors is understandable, but please understand the duty of RBI is to protect the depositors. And this is exactly what has been done by RBI. When this particular merger of LVB will happen to DBS, basically in the new books, only the depositors will be transferred like this. That is very, very important point that you need to make a note of. Next, fourth very important point is this. In the last couple of years, more and more financial institutions in case of India are coming under a lot of pressure, or these kind of financial pressures are happening in more and more financial institutions. For example, earlier this happened to one of the biggest NBFCs in India, Island FS, Infrastructure, Leasing and Financial Services. There was a problem with respect to Punjab Maharashtra Cooperative Bank. Earlier there was a problem with respect to Yes Bank, and now same thing has happened in case of Laxmi Vilas Bank. The problem with respect to this is, if Indian economy has to recover, then the banking sector will play one of the very important roles. In addition to banking sector, it will also be NBFCs, which are also very, very important in terms of achieving higher growth rate, or for that matter, even positive growth rates in the coming days. But increasingly what is happening is, because of various issues, because of administrative issues, lack of oversight in these particular banks, because of certain risky decisions that they have taken, because of various other issues, these kind of financial institutions are coming under a lot of financial pressures, and this is happening in the Indian economy. So there is a need to reverse this particular trend. In addition to this, RBI has imposed a moratorium for the withdrawals on these particular banks. Now, what is this particular concept of a moratorium? RBI has basically stated that the moratorium is applicable for 1 month, and during this particular 1 month, withdrawals of more than 25,000 will not be allowed per depositor. Again, in certain conditions, for example, medical expenses, if you take the permission, more withdrawals or beyond this limit is also allowed to be withdrawn. The next very important point, that is sixth very important point, is this. With RBI announcing the amalgamation of LVB into DBS, it is expected to promote functioning of foreign banks in India. And moreover, against this particular decision, various investors have already raised their concern. That is basically they are saying on what basis this particular foreign bank was selected by RBI and why specifically DBS. So these are some of the very important points related to the announcement of RBI to amalgamate LVB with DBS Bank. The next article is with respect to Internal Working Committee of RBI. Now, first and foremost, this particular Internal Working Group was headed by P.K. Mohanty. That's the first very important point. Now, most important, apart from this, is the recommendation of this particular Internal Working Group, because it is expected that there will be a lot of discussion with respect to these recommendations. There will be support from some quarters, there will be opposition from some quarters on some of these particular recommendations. First and foremost, this committee has recommended allowing corporate houses to set up banks in India. Now, RBI, strictly speaking, has been opposed to this particular idea of allowing corporate houses to set up and run the banks, because basically their concern is how can these particular corporate houses also be the owners and the borrowers in the same bank? Don't you think there's a conflict of interest, right? What about the transparency? There are so many issues associated with allowing the corporate houses to set up and run the commercial banks. But this is one of the very important recommendation given by this committee. And in the coming days, this will be the recommendation which will have a lot of discussion. Second very important recommendation is with respect to NBFCs. It is basically stated that those particular NBFCs with asset size of over 50,000 crore rupees could be allowed to be converted into commercial banks. That is a second very important recommendation. Again, there are conditions. For example, they are saying that they should have a function for at least 10 years, so on and so forth. Third, in case of NBFCs, the promoter's ownership should be increased from 15% to 26% over a period of 15 years. This is another very important recommendation. Fourth very important recommendation is with respect to payment banks. In case of a payment banks, if they want to convert into small finance bank, then the 3 years experience will be more than sufficient. Next recommendation, if these particular payment banks and SFBs want to be listed, then it shall be done after working 6 years from the date of reaching certain amount of net worth. Sixth very important recommendation is with respect to minimum capital. In case of setting up a bank or a new bank, the minimum capital requirement should be enhanced from 500 crore rupees to 1000 crore rupees. And second, in case of small finance bank, this minimum capital requirement should be enhanced from rupees 150 crore to 300 crore rupees. So these are some of the very important recommendations given by the internal working group that was set up by RBI to look into the ownership or enhancement of a capital requirement, so on and so forth, in case of the universal banks, in case of the payment banks, in case of the small finance banks. Okay, so this is the gist of the article given here. The next article is related to Atmanirbharta and its price. Now, in this particular article, they have discussed the negative impact that the concept of a self-reliance or Atmanirbharta will have on the domestic market or domestic economy. Government of India in the last couple of months has been pushing the idea of Atmanirbharta or self-reliance fervently and has been imposing certain guidelines or restrictions on some of the CPSEs. In this article, they have discussed the issue that is being faced by one of the public sector company, that is BSNL. Earlier, BSNL had put out a tender and had asked a request from some of the vendors in the market, including the foreign companies. Government of India asked the BSNL to withdraw this particular tender and start sourcing only from the domestic vendors. Now, citing certain issues, this particular company has written to Government of India. Some of the concerns which are raised by this particular company are, first, in case they want to source from the domestic vendors, majority of the vendors who have already shown interest are going to sell these particular equipments for the first time to this particular company. So these are the first time sellers to the BSNL. Second, when compared, that is in terms of prices, these particular vendors who are selling from the domestic market to BSNL or who have shown interest to sell it to BSNL are quoting 50 to 79% higher prices compared to when BSNL was sourcing these particular equipments from foreign vendors. Now, third issue is BSNL is competing with private sector companies in the market. Now, if this is competing with the private sector companies, then first and foremost, the equipment or the technology that they are using should be very much updated or should be very high. And if you are sourcing these particular equipments from the domestic market only, then there will be a concern with respect to this updated version of the technology or the updated equipments or the latest equipments. Second, if the equipment that is sourced is costly or the cost of the acquisition is going to increase, then the services which are provided by the BSNL will also get affected. And you expect the BSNL to compete with the private sector companies in the market. So these are the three very important issues which have been raised in this particular article. Just make one correction here. Rather than 79%, the article quotes that the prices which are quoted by the domestic vendors is 50 to 89% higher than what the BSNL would have paid if they had sourced from the foreign market. So these are certain very important issues which have been raised by the BSNL, which are cited in the article. Now the article goes beyond this and says the problem with Atmanirbharta is not just applicable to BSNL alone. It has larger implications for the overall economy. And this has cited one of the papers which has been written by Mr. Arvind Subramanian. And this particular paper basically cites that in case of India, the tariffs between 1991 to 2014 have reduced from 125% to 13%, and since then have risen to reach 18%. And this particular rise in the tariffs is predominantly because the duties have been imposed by Government of India on more than 70% of its imports, or more than 70% of the imports which are coming into India are attracting higher duties which are being imposed by Government of India in the last couple of years. And if Government of India wants to promote more and more economic recovery to happen, then the better way would be promotion of exports. And the promotion of exports would only happen if the imports are cheaper for these particular companies. So these are certain very important articles as well as the questions related to articles for this particular time period. Thank you. Have a good day.